Hi, everyone. Thank you all so much for being here this evening for our discussion, Adventures in Robinhood, the GameStop Escapade. I'm Allison Cafferone, Visiting Associate Professor of Law at Hofstra Law School, and I'll be moderator this evening. Tonight's panel, as you know, is going to focus on the Robinhood GameStop stock trading saga. And we are very lucky to have with us tonight our distinguished panelists. Ronald Colombo, Professor of Law and Associate Dean for Distance Education. Professor Colombo teaches business organizations, securities, regulations, contracts, and a seminar in corporate and securities law at Hofstra Law School. We have Linda Galler, Max Schmertz Distinguished Professor of Law. Professor Galler teaches a variety of tax courses, including corporate taxation. She's also the founder and director of the Hofstra Law School Federal Tax Clinic. And Daniel Greenwood, Professor of Law. Professor Greenwood teaches torts, business organizations, and corporate finance. So I know that tonight's audience is comprised of people from both the legal and business communities, and also includes people in different stages of their careers. We have students, practitioners, executives, and professors with us tonight. So before our panelists take a deep dive into the legal, policy, and practical considerations, I'm just going to try to put us all on a more equal footing by briefly walking through the factual background of what happened last month that led us here tonight. So a few weeks ago, the stock market experienced this series of volatile events, including most infamously GameStop's stock price surging from around $17 per share in early January to reaching a high of $483 per share less than 4 weeks later on January 28th. And so those of you who are unfamiliar with GameStop, because unlike me, you don't have a 15-year-old son at home, it's a brick and mortar store that sells gaming consoles, video games, the like. It was immensely popular back in the early 2000s, but as of late, it's begun to struggle as so-called gamers increasingly purchase video games just simply by downloading them electronically, rather than physically heading to GameStop. And as disclosed in the company's SEC filings for the quarter period ending October 31, 2020, the company's sales had been steadily declining and it was losing money. So now if it sounds odd to you, right, that in 2.5 months, the financials of a store would improve so dramatically as to cause the stock price surge of 1,600% in the month of January alone, particularly given the middle of a pandemic and people are staying home and other brick and mortar stores are going out of business, you would be right, they didn't. Indeed, if you were to look only at GameStop's fundamentals, there was no discernible reason for the tremendous rise in stock price. So as I imagine many attending this Zoom discussion know by now, the stock price increase was completely detached from the financial well-being of GameStop. Rather, it was the result of a significant number of individual non-professional investors, which we'll also refer to as retail investors, who either disagreed with the Wall Street hedge funds that had bet that GameStop's stock price would collapse, or if you have a more sinister view, wanted to stick it to the hedge fund and thus decided to buy into GameStop. So now it wasn't just a coincidence that tons of retail investors decided to buy GameStop at the same time. Many of these retail investors were communicating with each other on the Reddit forum Wall Street Bets, excuse me. In the weeks leading up to the trade, these investors began to openly post about GameStop stock, talking about the large number of shares that were held short by the hedge funds, and explicitly urging others to buy shares to move the price higher. And that chatter worked. So unlike the hedge funds who had shorted the stock, and we'll get into that, what that means, these retail investors bought and bought and bought GameStop shares, and they drove that price up. And they ultimately triggered what's known as a short squeeze, which required that in order to limit their losses, the hedge funds had to close out their positions, which, as I'll explain momentarily, required them to buy GameStop shares back. And that thus further increased the demand and the price of the stock. So now to fully understand all that happened here, you have to know what it means to short a stock and at least have a high level understanding of short squeezes. So I'm just going to take a minute to go through that. So first, what does it mean to short a stock? A short sale is fundamentally a sale of the stock by a seller who doesn't own the stock. And I know that that sounds strange, but it sounds stranger than it actually is, right? So say I borrow today, given the weather, I borrow your snowblower. And I think that snowblowers are overvalued at this moment in time. And I expect that the price of snowblowers is going to fall. So rather than hold on to that borrowed snowblower from you, I turn around and I sell it at that high price of $500. I do this because I think, in the next month or so, the price of the snowblower is going to fall and I'll be able to buy the snowblower back at a lower price, let's say $100. So I sell today at $500. I buy it back next month at $100, return your snowblower to you now, got it back, return it to you. And I pocket that $400 difference between the high price at which I sold it and the low price at which I bought it. So that's the same concept as a short sale. Short sellers believe the stock price is going to fall. So they go ahead, they borrow the stock from somebody else who owns it, and then they turn around and they sell it to an investor buyer at that high price that it's going for on the market now. The short seller hopes that the price falls, and so that when it does fall, she or he can buy it back at the lower price, return it to the original lender, and thus make a profit. Same as the snowblower borrower. That's exactly what the hedge funds were hoping to do with GameStop. They thought that the stock was overvalued, and so they shorted it. Two important things to understand about shorts before we talk about the short squeeze forced by the retail investors. First, shorts always require that the short seller buy the stock back at some point, right? So as to be able to return it to the original lender. Second, shorts are really risky, right? Because although the short seller thinks the price is going to fall, that price can rise. We don't know what's going to happen. And of course, there's no limit to how much it might rise. So it could rise $50 a share. It could rise $100 a share. It could rise $1,000 a share, right? There's literally no limit. And the higher the price goes, the more money the short seller loses. Okay, so that's a short squeeze. A short squeeze occurs when there's a rapid increase in the price of a stock that's shorted a lot. And if the price of the shorted stock suddenly and dramatically increases, those short sellers of that stock stand to lose a lot of money. So to put an end to that bleeding, they close out their positions. And as I was just explaining, right, that requires the short sellers to buy back the shares of the stock so they can then return those to the original lenders. When there are many short sellers all buying back the stock at the same time, that increases the price of the stock even more. And so the price just keeps going higher and higher. And that is precisely what happened with GameStop. That is only half the story. The other half of the story concerns the platform the retail investors use to place their trades. So many of these investors were trading using an app that you guys might be familiar with called Robinhood. It's a relatively new trading app that has become enormously popular with millennials and younger investors. It's got over 13 million users right now. Interestingly enough, half of those users had never invested before. Robinhood's kind of self-declared mission, right, is to democratize finance for all. And in order to effectuate that mission, what they've been doing is they offer commissionless free trades and no account minimums. You can go open an account with no minimum. And it's a fairly simple to use app, and it's got features that tend to make it more like a game. So many of these retail investors who bought shares of GameStops were using Robinhood to place their trades. Now on January 28th, the day that GameStop reached its high of $483, and as the hedge funds are losing a fortune, Robinhood decides to prevent its users from buying the stock. So they send out a tweet citing market volatility as the reasoning. Now, there are different opinions and views as to why Robinhood acted as it did, and we will get into that momentarily with our panelists. But whatever the story, right, it sent many people into kind of a tizzy. Congress decided to hold hearings. Maybe you watched that last week. Private investors sued, and the SEC said, and I quote, "It was closely monitoring and evaluating those events and will act to protect retail investors when the facts demonstrate abusive or manipulative trading activity." So tonight's discussion revolves around these happenings, and I'd like to turn now to our panelists to start delving into some of the more interesting legal and policy questions and the practical tax consequences of these events. So Professor Colombo, I thought I'd start with you tonight. How are you doing?
I'm
Thank you
well.
for being
How are
here.
you?
Good. So listen, so there are so many players involved here, right? And how about we kind of try to start with the retail investors, specifically those investors who are communicating using the Reddit forum, Wall Street Bets. So these Wall Street Bet folks were out in the public, right? And they're openly discussing their strategies and their reasons for buying GameStop stock. Do those folks face liability for what they were saying on the online forum?
Um, well, I don't think so. Probably not. But before I even get there, thank you, Allison, for that nice introduction. Thank you to my fellow panelists. Thank you to so many of my students. I see some former students in the audience, which is really exciting. Welcome back to our alumni and fellow instructors at the school, administrators, everybody. Thanks for showing up tonight. So, like I said, I think no. Private investors, have a right to speak their mind. You have a right to be wrong. You have a right to be stupid. Your right to be foolish. So I see this as this private chatter as probably not leading to any liability. It's if you're dealing with private investors just spouting their ill-informed opinions on Reddit. I think it's like we talked before. I think it's probably just free speech on their part, and to criminalize that would be problematic. But I don't see any evidence of crime on their part.
Okay, thank you. So you mentioned free speech there. Of course, all free speech, right, is not protected speech. So what if the investors, while speaking to each other, have the intent to band together or to coordinate their market moves? Does that change the analysis?
Well, and that's kind of what it looks like. So it does get more problematic. I mean, what we're moving down the road to what would be called market manipulation. But the market manipulation cases that I've seen first of all, you'd think that by now these elements would be clarified and everyone would know what they are, but there are actually still some ambiguity. But for almost every market manipulation case that I've seen, intent is important, but you almost always need a misleading or inaccurate or a false or misleading statement of fact or perhaps of opinion. For private investors, I just don't see evidence that there's that smoking gun, that somebody said something that they knew was wrong. I mean, they said, let's buy this so it goes up. But everyone who buys something hopes it goes up. So I don't see a problem with that chatter. So without more right now, I think the private investors are probably okay.
Thank you. Professor Greenwood, so this kind of discussion we have on the one side, right, we have the individual traders, and then we have, as they've been portrayed, the villains of Wall Street. Would you kind of describe that as, would you say that's an accurate picture?
So I actually have a somewhat different take than the way that Professor Colombo presented it, and even the way you presented it. So let me first thank you for opening the forum and letting us talk and let us debate about it. I think this is really kind of fun. To me, this looks like a classic form, one of the oldest forms of securities fraud, a pump and dump scheme. Now, I'm not a securities lawyer, and I'm not going to talk about the standard of proof, and don't know the facts well enough to know whether a prosecutor could actually bring an action and prove it. But being able to prove it is different from whether it happened or not. So let me talk about what a pump and dump scheme is and who I think the villains are here and who are not. All right. Unusually the villains actually are not the Wall Street professionals, maybe, but maybe there's more to be learned. So a pump and dump scheme works like this. You get together a group of people to claim that a stock is undervalued and it's going to go up. You then create some information to make it go up. But sometimes that information just is, it's going to go up. It doesn't have to be anything substantive, because stocks sometimes go up just because other people think they're going to go up. And then they buy them and that makes it go up. And then, it becomes a self-perpetuating bubble, which is what this was. It's pretty clear here that most of the people who were buying this stock were not buying it because they thought, as Allison suggested, right, that it had these great unrecognized potential for making a lot of profit. They were buying it because, or at least they said they were buying it, in order to make the stock price go up, or because they thought the stock price would go up. And that's a bit of a self-fulfilling prophecy. So in a pump and dump scheme, what you do is you get the excitement going. The excitement causes the price to go up. Then you point to the price going up and you say, look, the price is going up, and that increases the excitement. The people who instigated this eventually sell before the whole thing falls apart. If you remember, if you ever saw the Mary Poppins movie in your youth, there's a moment where there's a bank run where the little boy, whose name I've forgotten now, goes into the bank and says, I want my penny back. And in 3 seconds, everybody has decided that the, sorry? Michael, thank you. Michael wants his penny back, and then everybody panics, and they all want their money back. And then of course the bank fails because the bank can't give you all the money back. This is the same thing in reverse, all right? Now, to the extent that this is true, what actually happened, the investors on the Reddit were the villains. They were scammers who were basically ripping off the other investors on the Reddit. The short sellers were a sideshow. The real show is one group of investors is convincing another group of investors to buy worthless stock, or stock that is worth less than they're paying for it, hoping that this will create a cycle, and then the first people will be able to run out. Now,
this is so interesting, Professor Greenwood. I'd like to get Professor Colombo's take on that.
So let me just get one more sentence in, and then I'll turn it back to Professor Colombo. One more thing that I think is really important to notice is that the people who were doing this were not all little folks who had never bought stock before they discovered Robinhood. They included Elon Musk, who is, I think, now the second or first richest person in the world. So he's certainly not a little retail investor. And I suspect that we're going to find that that there is something approaching intent here on that side. So I'm going to turn it back to Professor Colombo, and then maybe I'll have a chance to talk about the big bad guys on the other side at some point.
Absolutely. Please, Professor Colombo, if you could weigh in on that.
Extremely briefly, I think I agree almost completely with Professor Greenwood. This does have all the characteristics of a pump and dump. I just think for the individual investor, you're unlikely to find the smoking gun of anything beyond a vague intent that it's going to go up. Now, for a hedge fund or someone professional, and you have where you have access to perhaps an email trail, where the hedge fund has access to research reports and to economists and to, real expert advice on this sort of thing, I think you may be able to find a smoking gun if you could find a hedge fund promoting this inflation of the stock price, if you could show that they knew or should have known that this was all bunk. But for an individual investor, I just don't think you're going to be able to have the evidence necessary to show a genuinely false or misleading statement that I think is at the core of these schemes.
So I was just going to add, I'm sorry, Professor Greenwood, this goes to either one of you, but I just want to make sure we're very clear to our audience. So to the extent that there was no false statement, knowingly false statement put out by the people on Reddit, could this still be a pump and dump scheme? Because like you said, you said this is all, whether if they knew this is all bunk, Professor Colombo, but I wonder what is this in that? Because if it's simply saying we'd like to get back at the hedge funds and buy GameStop, would that still be a pump and dump?
So I would say if the goal here was to punish the hedge funds, and that's the only motivation that can be proven, that does not seem to me to be a pump and dump scheme. That's a mob. And as far as I know, mobs are not, in this context, are not illegal. They're definitely not a pump and dump. But if the email trails say, which I think they do, although this is secondhand, so I may be wrong, but if they say things like, buy this stock, it's going to the sky, That's actually the classic 1920s pump and dump that led to the formation of the SEC in the first place. It wasn't a false statement in the sense of everybody wants to buy GameStop games in the stores, and so this obsolete company, you're all wrong in thinking that this company is obsolete. It's actually a great company. You don't need to do that. It's enough to come in and say, buy this stock because it's going up.
Thank you. I want to, at some point, I want to get to Robinhood, but I know, Professor Greenwood, that you wanted to talk about the hedge funds before we do that.
So let me just say this, right? Because the hedge funds are the villain, right? The thing that the Reddit folks said was, we're going to take down the hedge funds. And they actually even seem to have, if not succeeded, at least in costing some hedge fund $1 billion or thereabouts. So they did some damage. They did some real damage. And the congressional hearings, a lot of them were focused on the terrible short sellers, where they weren't focused on the terrible Robinhood. And I'm going to take the opposite position on both of these. I think Robinhood did exactly the right thing in closing down the trading. At the point at which you have a stock that is obviously not worth $400, trading at $400, somebody's going to get really hurt. And the person who's going to get most hurt is the one who buys at $400, thinking they're going to sell at $500, and then ends up selling at $20. And by closing down, Robinhood saved those people an enormous amount of money. Now, they're not in the congressional hearing because they didn't get a chance to lose all their money. So we're not going to hear from them, but they are the victims who didn't happen. The hedge funds, Professor Cafferoni explained to you how how short sellers work, but it's important to notice that when a stock is overpriced, this is what drives it back to its true value. This is what makes sure that people don't waste their money on overpriced stock. And for example, one of the things that happened here, a little thing that happened here, was that the GameStop sold new stock into the bubble. So they sold incredibly overpriced new stock to retail investors, or non-retail investors, but to investors, which means that we collectively provided a whole bunch of new capital to this failing company to survive a little longer. It's not clear that that's socially useful. That money should have gone to something more useful than an obsolete company. The short sellers help because what they do is drive the stock price back to reality. And we ought to be cheering them here. We ought to be saying they saved a lot of people even more money.
Thank you, Professor Greenwood. Professor Colombo, we hear from Professor Greenwood that he thinks that what Robinhood did by stepping in, just so everyone's clear, right? I think you all know this, but so they prevented users from buying their GameStop shares on January 28th when they shut that down, and they attributed it to market volatility. But then they came back and said they were required to do so. And so I'm curious, Professor Colombo, even if perhaps it was a good thing to do socially, can you weigh in on whether it was actually against the law, or whether they broke the law by doing that?
Yeah. Well, once again, I agree completely with Professor Greenwood, I think, on almost everything he said there. I was listening very carefully to the congressional testimony, waiting for some evidence of wrongdoing. Remember, people speculated at the beginning that there was undue pressure put on Robinhood to sort of stop the purchasing of the GameStop stock. And so far, there's been no evidence of that. Now, clearly, if that evidence comes to light, that's a problem. But so far, we don't see it. So far, what we see is GameStop acting in order to fulfill their capital requirements with regard to the situation. And here's a situation that I think people have to understand without getting to too much of the weeds. Robinhood allowed investors to invest on margin. You were allowed to invest up to twice as much as your account at Robinhood. So if you put $2,000 into your Robinhood account, you could buy $4,000 worth of stock. So let's say I put $2,000 into Robinhood, and then I buy $4,000 worth of stock, and that stock starts to plummet. Robinhood's going to eat that if they can't come back to you. In other words, Robinhood is facing exposure on that purchase. And if it goes down too deep and you only have your $2,000, you can't make good on the $4,000 because they let you buy on margin. Now Robinhood is going to eat that. There are capital requirements, but again, without getting the details, that Robinhood had that forced them to do a timeout. And as Professor Greenwood said, they actually ended up saving people a lot of money because they stopped the buying of the stock, not the selling of the stock. So I agree that they did what they had to do. And so far, there's not evidence of anything nefarious.
I would go further. I would go further. I think I think that if they weren't required to do that, they should have been. They should have been required to do it at $200, not at $400.
Thank you. And do you think we'll see any type of, when you say you think that they should be required to do that, do you think that we're likely to see any new regulations or legislation in that area?
Well, in the old days, the margin requirements used to be enforced quite rigidly, and they got quite small for a while, so that you weren't allowed to borrow that much money, precisely because one of the theories of the 1929 crash is that it was caused by people doing exactly what happened here, borrowing money in order to buy stock because they knew the price of the stock was going to go up, overpaying for the stock because what does it matter if you overpay if you can then sell it for even more?
Professor Colombo, I wanted to let you weigh in on that. I want to get to payment for order flow, but I also wanted to jump in.
I would like to ask Professor Greenwood a question because I agree with you on short selling. I think it gets a bad rap. I think it is a very important part of the market. But what do you think about, in terms of future regulation, the fact that people can short more sales than there even are in the entire market?
Yeah,
doesn't that seem like an abuse, or you're okay with that?
No, there's something went wrong here, and I don't fully understand it. The complete short squeeze is when people have borrowed and sold more stock than can be bought back, and that seems to have actually happened here. Now that strikes me as a failure of the regulatory system and possibly a violation of it by the brokers. But I don't know the details to know why this could even happen. But it definitely shouldn't be allowed.
So we may see more regulation, I think, in preventing a recurrence of that situation where people actually sell more stock than is outstanding. It seems pretty ludicrous.
It comes from an artifact of the way the borrowing is done. The same share of stock can be loaned twice, and there doesn't seem to be an overall count of how many shares have been loaned out to be sold, and that clearly needs to be fixed. It's crazy.
Right, because maybe you got right. So the naked short selling, right, is prohibited. But I think what Professor Greenwood is saying is that this is different than naked short selling because it's somehow the way it works. The same share is being borrowed and sold twice rather than a non-existent share. Is that the difference here?
As I understand it, what happens is if you have stock in a brokerage account, the brokerage firm can lend it out without your knowing, without your permission and without your knowledge. So they lend it to somebody who sells it. Okay, now, but you still own it. And you can sell it too. So now the same share has been sold twice. And we've seen this problem with the same share being voted twice, and we have not dealt with it. And I think that that's something like what happened here. But obviously, if now the people who borrowed it try and buy it back, you can't buy the same share back twice. And so at some point, there's somebody who is left trying to buy a share of stock that doesn't exist. And that should make the price skyrocket in a way that's going to get somebody really badly hurt. Now, what we hear about are the people who made the fortune.
Isn't it even more than that? Because if you're the person who owned the stock, you could actually short sell against the box. In other words, you could short sell. So that's 3 times basically.
Right. And so something we need to fix that. This is a technical detail that has failed.
Thank you so much for that. That part of this is fascinating. There's another really controversial point that Robin has been involved with, and that is the payment for order flow practice. And Professor Colombo, I was wondering, so if you could kind of talk to us about that for an instant, because I think it's probably interesting. Many people are probably having the question, okay, if it's a commission-free trade, which means that, you know, they're not making money off the trades, or at least from the retail investor side, right? But can you explain what payment for order flow is, and second, why it has come under scrutiny?
Yeah, well, this has come under great scrutiny, and it is controversial. And I definitely want to leave time for Professor Galler in the audience, so I'll give you it in a nutshell. It used to be you'd have to pay a commission on your trades, but you have now the advent of commissionless trading, free trading, right? So how's that financed? As we know, there's no such thing as a free lunch, right? So how is it that investors in Robinhood could buy and sell stock without paying a commission? Well, it's because of this thing called payment for order flow. What Robinhood does is it takes these transactions, one here, one there, 10 here, 10 there, 100 here, 100 there, bundles them, and then sells them to market makers who I pay, I think, about 1 or 2 cents a share. So that's how Robinhood makes their money. Robinhood makes their money by taking your trades, if you're a retail investor, and selling them to a market maker who will then execute those trades on your behalf. And so the market maker will pay Robinhood. That's how Robinhood makes their money. Now, why do the market makers, why are these brokers paying for the right to execute your shares? Well, because they could profit on it. They could, I mean, the simplest case is they buy it for a little less and then sell it to you for a little more. And they make a profit on that spread. It's controversial because, you know, are the investors getting fleeced or not? Quite frankly, I think for the small retail investor, it's probably pretty good because I don't think you want to be paying $10, $20 a trade when it's low volume amounts of trades. But again, reasonable minds can differ over this. I don't see this as that awful. Especially
I think reasonable minds may differ over this, because if I'm looking at Professor, and if I'm reading Professor Greenwood correctly, I think he disagrees with Professor Colombo.
Well, there's more to it, but I'm happy to.
The reasonable part, but definitely disagreement.
Okay, I'm happy to hear what you disagree with on that. And there's more to it, but go ahead.
So just in a sentence, what the people who are buying the order flow are doing is what we used to call, when it was uncontroversially wrong, front running. They know what they know what you've offered. They're going in ahead of you, making a trade ahead of you, and then profiting by basically getting the trade you should have gotten, right? Now, from a retail perspective, look, they're making a tiny amount on each trade, and you probably don't even notice that you're being ripped off. So maybe that's the side that, you know, from Rana saying correctly, right, might feel like a really good deal, that you don't pay for your trade, and so you lose this fraction of a cent that you didn't even know about anyway.
Yeah.
They're making a mint, though, and they're making a mint in a way that is fundamentally antisocial. They're basically wasting a lot of resources trying to be faster in a way that is useless. So that's half of my disagreement. The other half is this: I actually think that we should charge people for trading, because trading is by and large not a great thing. It doesn't do much for the world, and traders themselves, especially small retail traders, are much more likely to lose money than make it. They get ripped off, as they did in this scenario. And so making people think twice before they trade probably leads to them having a better retirement, and almost certainly leads to those of us who are not in the stock market having a better economy. So.
You know, I just want to go back to something that Professor Greenwood said. You know, a friend of mine told me this was right. He told me this after the Robinhood GameStop thing, but he and his son had performed an experiment a few weeks before all of this, just in normal times. The son was insisting that the son, being a millennial, was insisting that this app was the way to go. The father had a old-fashioned Schwab account that, you know, was paying no brokerage commission, and they both bought the same stock at the same amount and sold it at the same time for the same amount, and they did it a couple of times. The father always made a few cents more than the son. Well, and they were at a loss to understand why that was. But I think it's for exactly what Professor Greenwood was just describing there. So to them, it was just a few pennies and it was very interesting, but across a large population of retail investors, it raises questions.
Well, these statistics have to be published and made available to investors, right? So they're supposed to realize which brokers have better execution, and this should be public knowledge to them. Now, who actually reads that and worries about that for a few cents here, a few cents there, that's where they get fleeced. But the information is out there if they want to understand what's happening to them. But again, I mean, Professor Greenwood touches upon issues of sort of just political philosophy, if you will, right? In other words, should people be free to blow their money on the stock market, or should we charge them and make it more expensive and put up hurdles? That's a very interesting debate. But
well, may I ask you? So, does this series of events that we're discussing here tonight, does that suggest that someone needs protecting? And if so, why, Professor Greenwood?
So I'm going to say, for purposes of the economy as a whole, which concerns me more than either the hedge funds or a bunch of people who've decided to gamble on Reddit, based on Reddit, right? I'm more concerned about the functioning of the economy. Transparency in pricing is one of the basic predicates of a functioning market economy. And part of what's going on here is the pricing is invisible. You don't know what you're paying. So that's just, that took, to my mind, we have a better society and a better market if you know what you're paying. Now, do people need to be protected? Well, I mean, this is gambling. I assume that almost all of the people involved in here understood that they were gambling. As we know, people make and lose a lot of money gambling, and gambling can be really dangerous. So, we need some mild restrictions on it. I'm not in favor of I don't think there's anything here that needs to be banned, but I think making the pricing transparent, making people realize what they're doing is perfectly reasonable. And I think placing limits, particularly on places where you can lose huge amounts of money without really understanding what you're doing, margin selling in particular.
Professor Colombo, do you agree this is gambling? Do you see it as a political movement or simply investing?
I think it's all the above. I actually agree with Professor Greenwood, except for that last part. I mean, I'm not a fan of protecting people from themselves. I think you arm them with the information. Certainly you need to arm them with quality information. Whether they understand it or not, or choose to invest without understanding it, I think that's really up to them. I am concerned about potential systemic risk. And so when this thing first broke, people thought, is the market broken? Is this going to take us down? It didn't seem to do that, right? We seem to snap back. If there is evidence that this sort of activity is destructive to the economy as a whole, then obviously I would want to revisit. But that didn't seem to happen. Did we dodge a bullet, or is this really overblown? I don't know.
It's just too little. But now that it's clear and legal, if it turns out that it's clear and legal, why would you do it on this little scale? Why not make $1 billion? Why not make $10 billion? And then it will be systemic.
Yeah, I'm not so sure. Well, again, I'm not so sure that would happen, but I do agree in quality information, but I don't agree in, again, protecting people from themselves.
This is a fascinating discussion, and I appreciate everyone weighing in on this. But I do want to get Professor Galler in on this too, and also the audience. So we have hit on the legality of the actions of some of the major players here, right? But what about the consequences to the retail investors who traded in GameStop, particularly since many of them, and I know there were, Elon Musk was among, but many of them were first-time investors, and they might not have a real sense of the tax implications, and some of them may actually be with us tonight. So Professor Galler, if I could turn to you, assuming an investor, I'll just start off with this, but assuming an investor sold stock and profited on that sale, what are the tax consequences for that investment income?
Well, the tax consequences are actually very simple, which is that the difference between what you paid for the stock and what you sold it for is taxable gain. And that's taxable. I think what is of concern with respect to those who are new to the world of buying and selling stock and who made a profit, particularly a large profit on the on GameStop or on AMC or one of these, is that they might be surprised to realize the extent of their tax liability, and B, particularly if you're somebody who works for someone else and you're used to having an employer withhold your taxes over the course of a year, so that when you file your tax return in April, you don't owe a whopping amount, or you count on getting a refund. For these particular investors, they're going to have an awfully big tax bill, potentially, depending on what the size of their gain was. And if they wait until, so this is 2021, if they wait to file their 2021 returns until the spring of 2022, and they haven't paid in to the system before that, and what we refer to as estimated tax, they're going to end up actually with a penalty for late payment, because you can't wait until April 15th of 2022 to pay those taxes. And I think the rules on estimated tax and what you have to pay can get a little bit complicated if you're somebody who's not used to doing that, or you didn't even know you had to do it. It gets complicated. I get concerned that people think that they have made a large profit, and so they can use that profit for some other purpose, whether it's investing in something or just spending it on something fabulous, without thinking that they need to put away a fair amount. And I think maybe we'll talk about what that fair amount is, but it's a fair amount of money that needs to be put away and paid over to the IRS and or state tax authorities out of their profits.
Thank you so much. Can you explain to us, are these gains that are made, are they going to be taxed at a short-term or a long-term rate capital gains, and what's the difference?
So for the retail, for we're calling the retail investor, the person who invested through Robinhood, the likelihood is, first of all, gains on the sale of stock or gains on the short sales, gains on sales of options, they're all what we call capital gains. But capital gains, there are two different kinds of capital gains. There's short-term capital gains and there are long-term capital gains. And the lower tax rate that applies with respect to capital gains, what we hear about or what we read about sometimes if we pay attention to these things, only refers to capital gains of sales from assets that are held for more than a year. So if somebody bought the Robinhood stock and sold it in the course of what you described, Professor Cafferon described earlier, they're going to end up with short-term capital gains. And those capital gains are taxed at the exact same rate as what tax lawyers refer to as ordinary income, the same thing as your wages. And those cap out at 37%, whereas capital gains cap out at 20%. And most capital gains from most people are actually, many people, actually 15%. There's also a sneaky little add-on tax to any kind of capital gain, short-term or long-term, of 3.8% that came to us in the Affordable Care Act, which some of you may call Obamacare. And that's for people over a certain income level. So depending on where the person was to begin with, in other words, what their salary was or their wages are and or how much profit they made, they actually could potentially be taxed 37% or up to 37% or somewhere in the 30%. So maybe 30%, let's say, an additional 3.8%. And I doubt they held their stock for over a year. And so, it puts the investor in a little bit of a pickle, because on the one hand, if you want a lower tax rate, you need to hold that capital asset for a year. On the other hand, if you hold it for a year, you may have missed out on the opportunity to make a killing on the profits here, because the whole idea is it was a pretty short-term investment.
That's so interesting. You said something about you had mentioned paying state tax as well. So the investor here has to pay both into federal tax and state tax?
So most states, not all states, but most states have an income tax. You might have read about Elon Musk, who apparently just relocated from California to Texas, of all places, this week. Texas doesn't have a state income tax, and California has a state income tax, and it's rumored to go up at the top end, and so he took off for a no tax state. New York has a pretty healthy income tax, and there is no preferential tax rate for capital gains. So those rates, the highest rate can be almost 8.8%. And by the way, for those of you who live in New York City has its own tax rate, which could be anywhere from 3 to 3.9%. So if you are a New York City resident that has short-term gains from one of these purchases and sales, you're going to end up paying federal income tax, state income tax, and city income tax, and no rate preference. In other words, whatever the maximum rate is that would apply when you add that gain to whatever your other income is for the year, it's going to be a pretty hefty tax bill.
Thank you so much. Okay, so those are the people, right, who made a profit. What about the investors who were not so lucky as to have made a profit? Can their capital losses be offset by capital gains or income from other sources?
So that's a really interesting question. So if you end up with capital losses, capital gains, it's a heads I win, tails you lose situation for the government. Capital gains are taxable. Capital losses are not subtractable, deductible, usable from so-called ordinary income. They can only be used to the extent that you have capital gains. So if you're somebody who's doing a lot of trading and you have some gains and some losses, you can use those losses to offset those gains and only pay tax if the gains, net, exceed the losses. But if you only have losses, or you have losses that exceed the gains, you can't use the excess, with one tiny little exception. For individuals, you can use $3,000 a year against your other income. And so you don't really get, there was an example in the congressional hearings. It was a guy named Salvador Vergara, who apparently took out a personal loan for $20,000 to invest in GameStop. And rather than going up, the stock, by the time he sold it, went down, and it went down by 80%. So he bought the stock for $20,000. He sold it for $4,000. He ended up with a $16,000 capital loss. Now, I don't know anything about this gentleman, but if he had no capital gains from other sources, that $16,000 is not going to do him a whole heck of a lot of good in 2021. He'll get to use 3,000 of it, but the remaining 13,000 of capital loss will not be usable. The good news is that you can carry that forward into subsequent years. And so maybe he'll have a better investment next year, and maybe he can use that investment. But it's an issue.
Thank you so much for that. Actually, thank you to all three of our terrific panelists for such an interesting and informative panel to discussion tonight. We have about 10 minutes left, and so I'd like to take a few audience questions if we can. And so the best way to do that for those of you in the audience is if you want to go ahead and type those in the chat. And then I'll go ahead and take a look and see what I can get to, and I'll do my best to get to you before time runs out. It's interesting, we've had a few comments already, and so one that I've seen come up quite a bit is there is a lot of pushback from our audience on the notion that Robinhood was in the right or had done something good by halting trades. So I wonder, is there something that really makes you weigh in to say that Robinhood here, this is the right course of action that they took? I mean, one interesting part about it is they say that one of the commenters said that the margin requirements had actually been waived prior to Robinhood halting it. And does, first of all, is that true? Do you know? And does that matter?
I haven't heard about that, but I'll give you for those of you that don't like Robinhood, here's what I would say. First of all, I agree that I think Robinhood, despite our audience, I do think they did the right thing. Again, barring a smoking gun, which I haven't seen, but to the extent you could fault Robinhood, I think there is some fault here. For one, they did make trading like a game more than anything else. And, that's not that responsible. There are studies about the psychology of people. And when you do little confetti every time you make a trade and whatnot, they preyed upon people's psychological weaknesses to get them to trade a lot and irresponsibly. Number two, and even more important to me, the number two one was, I don't think it was clear to people that Robinhood had the contractual right to stop trading this way. I don't think the investors realized that that this could happen cold turkey, boom, no more trading. So to the extent that you want to fault Robinhood, I would say, you know, it doesn't help to make stock trading more and more like a gambling game. That's not a good thing, and they contributed that. But even worse, I don't think investors were sufficiently informed. Disclosure, we keep coming back to that. I don't think investors were sufficiently informed of the fact that their accounts could be frozen like this. And I think that if you want to blame for anything, I blame them for that.
Professor Greenwood, do you agree?
Look, I don't think it's entirely appropriate for a single company to be determining when the market is getting out of hand. We're supposed to have regulators to do this, and it's a sign of much of the destruction of the public sector over the last generation, that that we didn't have an outsider who wasn't in a conflicted position, sitting there and going, this is a bubble, this is a pump and dump scheme. Even if we can't prove it, we can stop it before more people get hurt. And there should have been a neutral party, not Robinhood. So my bottom line is Robinhood did the right thing, but I have no idea whether they did it for the right reasons. And I don't think it's appropriate to have that be the decision maker here.
Something that hasn't come up a lot, I haven't seen it covered in the press. I'm assuming this, but if you had a typical broker, you could still buy stock in GameStop, couldn't you? In other words, wasn't this a Robinhood crisis more than a GameStop crisis?
Right.
So,
Yes,
that part of it was the other broker. The trading in GameStop did not close down, as far as I understand.
exactly.
The market does sometimes close down trading when stocks are going crazy, but that isn't what happened here. I think it was just one platform. So
Yes.
So the sophisticated traders presumably just switched to another platform and continued their game for a little while.
Yep. So this is why I don't. Yep. Okay. I agree.
Can I ask a question? I don't see how I'm coming. I was fascinated to hear what Professor Greenwood said earlier, because I've been thinking in the last few days, getting ready for today's panel, what the heck is the good, if any, results from permitting short sales? Because what sounds to me is you've got a group of hedge, and I think maybe what the Reddit group was responding to, other than, hey, this is fun and let's get the man and all that, was that, some hedge fund sat there and said, hey, there's a company that's not doing very well. Let's get out of front of it and let's make money off of their demise. Rather than taking money and saying, let's put money into this new startup that's going to do some great thing and create some value in society, let's just make money because we see an opportunity in the market here. What's the reason that we permit these things on such a broad scale?
So it is important to notice that a short seller drives the price of the stock down, but doesn't hurt the company, except in its ability to sell overpriced stock. So if GameStop was making money from its stores, all the short sellers in the world aren't going to stop it from making money in its stores. All they're doing is driving the price of the stock down, and a competently run company is not depending on its stock to run the company.
But if you look at, you're using the word, you were asking the question earlier, is trading gambling? And if you're really thinking about making investments that somehow better society, if somebody out there has a lot of money, I'd rather them make money by putting money into something that has some positive value, as opposed to making money just because there's some weird market thing going on.
Professor Colombo, could you weigh in?
Yeah, I would like to weigh in. So that's a point well taken, but I do think you're discounting the fact that by short selling one company's stock, Professor Galler, and driving it down, yes, that investment could have been put perhaps to more productive uses. But by driving that stock price down, everybody else sees that price is going down. And so all those other investors who would have invested in GameStop are now going to put their money to more productive uses. So there is a silver lining at a minimum, I would say, to this activity.
I would put it even more. GameStop sold a lot of stock itself, right, at the high price, which means it basically robbed a bunch of investors. And the short sellers are there to make sure that that doesn't happen. So
I saw that there were a number of the other companies that were part of this. I think Koss, which makes some headphones, they did the same thing. I don't know if AMC did, but I did see that.
I mean, if you see that people are willing to pay 5 times value for pieces of paper, you should sell them pieces of paper, right?
And on that note, we are out of time. And again, I just want to thank all 3 of our outstanding panelists, and thank you to everyone tonight in the audience for joining us.
Thank you so much for having us.
Thank you.
Good
Bye-bye.
night.